Well, good morning, everybody, and thank you for joining us on this webinar this morning. I'm delighted that so many people were able to sign up for the course, for the discussion that we'll be having. Before I introduce our speakers today, I just wanted to mention one thing that may be new to you if you haven't been on a webinar before. We do have a question and answer feature. The feature should be visible in the bottom right-hand corner of your screen. To expand it, simply click on the right-hand arrow, and at the bottom of the screen you'll see a box, a free text field, where you can type a question. And once it's ready, just simply press enter to submit. The questions can be submitted at any time during the webinar and will be anonymized. They will come through to me and the other four panelists, and I will try and read out as many as possible during the course of the discussion we're going to have. If for any reason the Q&A panel isn't visible on your screen, there should be a more options button on the control panel. That's the button that has 3 white dots. And if you click on that, you'll see Q&A, which will be an option at the top. So click once on that, and that should enable that that function. So let me get on to the people that we have on the call today. First of all, we have Tom Ward-Oldham. Tom is a partner in Galbraith, working principally across the north of England. He acts as a consultant and as a trusted advisor for many estates, specializing in estate management, in strategy, tax planning and development agreements. And his particular interests are in the uplands, heritage assets and diversification. So good morning, Tom, and welcome. We've got Peter Harker, who is a partner at Safri Champness in London. He also specializes in land and estates and property owning businesses. He provides a bespoke service to clients by helping them with both their audit and accounting needs, their tax compliance requirements and tax planning. He's also a member of the Institute of Chartered Accountants of England and Wales Farming and Rural Community Committee. Aidan Fake is a senior private banker at Weatherby's. He's able to advise private clients with advice on both their borrowing and their borrowing and investment needs, and specializes in working with farms and estates. And it's worth mentioning, Aidan, I think this year is Weatherby's 250th anniversary. So happy birthday.
Thank you very much.
And finally, we've got Sophie Tidy, who's a director in Savills rural team in Oxford. She's focused on the management of rural estates for private and institutional landowners, mainly in southern and central England. She's involved in a number of estates where significant diversification and the development of trading enterprises has taken place, alongside the more traditional residential and agricultural elements of the portfolio. So without any further ado, I'm going to move into the 3 themes that we set out in the email that went out. The first one being agriculture, leisure, and hospitality. Tom, food supply and food chain have been heavily in the news over the last few weeks since the outbreak of, since the lockdown. What are you seeing in your practice?
It's quite extraordinary to think that only 3 months ago we were still talking about Brexit, and the top topics were the agricultural bill and the forthcoming demise of BPS. There'd been sort of indignation across the farming community that the first edition of the agricultural bill had no mention of food security at all. And I think it's been shoehorned into the second edition, but it's pretty cursory. But COVID has quite clearly brought the words food security right up the agenda. And I hear quite a lot of farmers saying, told you so. But I think the food security issue is quite a lot more nuanced than that. But whatever, it's right back on the agenda. and hopefully it will influence policy on the agricultural bill as it goes through. But if you look at it, the sort of totemic products that we've been looking at are loo rolls, which we couldn't get hold of, nothing to do with the food chain, and then pasta, possibly, which it's an import from Europe, of all places. So really the short-term issue has not been so much with the quantity or quality of product, it's to do with the supply chains. And as the word suggests, if you get one link in a supply chain that goes wrong, everything grinds to a halt. One of my oldest daughters working in a flour mill locally drafted in to help. And they're interesting there. Their wholesale has more or less disappeared, but switched to retail. The problem has been not the supply of flour, but the ability to put it into 2 kilo bags rather than 20 kilo bags. And this is, but there is a massive demand now. Apparently, again, flour is the stuff you can't get in the supermarket shelves. Where have all these bakers come from? Have they learnt it fresh, or is it coming back? So really interesting angles on everything. But whether the trends subsist into the next, after the next 12 months when we go to normal, I think it's the key thing is to push where the windows are already open. It will slip back into junk food probably, but we need to hang on to what we've got.
Thanks, Tom. Sophie, looking at what you're seeing with your clients and visitor experiences in particular, what actions are being taken?
I think visitor experiences, along with wedding venues, events, and many other trading businesses, to be honest, on estates, have clearly been put on hold by lockdown. However, it is worth saying that there have been some strong growth areas, as Tom was alluding to, such as farm shops, whilst farm cafes have clearly been badly hit. I think looking ahead, the impact on visitor attractions will vary significantly depending on their character. Outdoor attractions or open gardens, for example, should be able to adapt to social distancing and could actually recover quite quickly once the government restrictions lift further. I think the real key there is managing to sell the hygiene measures that have been put in place to give visitors the confidence to return. I think the area where we will see some difficulty is with indoor heritage experiences. Some are thinking about how to innovate with virtual experiences, but most have already taken the decision that they will be closed for the whole year. Some are looking at how they could replace this income, where they've got perhaps surrounding gardens or parkland, and to try and focus on them. And where cafes are closed, for example, venues are considering options such as whether a sort of a boxed picnic scheme where people simply turn up and collect the picnic could replace the sort of the cafe element. I'm probably an optimist, but maybe we'll see some real innovation as well. We've seen some festival organisers talking about drive-in fireworks, concerts, cinema screenings. So there might be an opportunity there, as seen in South Korea. But the list goes on. I can talk about weddings as well, but that probably is the main bit on the visitor attractions.
Sophie, we've had a question about tenants who perhaps are being forced to be closed, such as cafes or pubs, restaurants. How should people be dealing with those tenants? Let's say they've got rent calls coming up in the next few weeks. What approaches are being seen in the marketplace generally?
I think, to be honest, there's no one size fits all. We've clearly been having a lot of these conversations from the very off, and certainly early on, it was quite a fast-moving picture. And I think where decisions were made very quickly, they weren't necessarily the right ones, because we then saw the government package of support change on a sort of daily basis. I think the real key has been early communication and regular communication with tenants who understand their particular financial issues. Is this a short-term cash flow issue, or is it a longer structural issue? It also varies depending on tenant as to whether they were a highly successful tenant with a very good rent-paying record prior to the present circumstances, or whether they were a tenant with a sort of a history of tricky debt payments who, to be frank, may not be able to adapt and survive this period. So the response very much depends on those factors, and where possible, we have been looking at trying to help short-term cash flows through rent deferment rather than any immediate change to the overall rent due, but that does vary on a case-by-case basis.
Yeah, so very much it's about deferring rents, not reducing rents, and seeing what transpires later in the year.
Right.
Yeah. Peter, insolvencies are obviously a risk to landlords. Are you seeing that coming through in your practice at the moment?
Similar to Sophie saying, landlords having to look very carefully at their tenants and whether their tenants are going concerns, and then also the impact that has on their own position. Just before I directly answer the question, just one point I'd like to pick up from Sophie's point with rent deferrals. There's some very practical VAT cash flow management things which people need to consider where rents are being deferred. If they are still going to raise a VAT invoice for that rent, then the VAT may become payable on the rent, assuming the commercial rents, before the rent's actually collected. So we're sort of advising clients to look at their invoicing arrangements and perhaps not raise a VAT invoice where rent has been deferred, just to help managers' VAT cash flows. And sorry, just to go back to your point about the viability of businesses, is something which we're talking to a lot of our clients about and helping them plan and understand what their cash flows are going to look like over the next coming months and couple of years. Cash is king. It's vital to manage it and understand how you're going to meet your requirements. We've been talking to a number of clients, helping them sort of model the cash flows to apply for the coronavirus business interruption loan schemes and other finance and banks, which I'm sure Aidan can comment on shortly. And also one very important consideration, the government's introduced various very helpful cash flow management tools, deferring various taxes into next year. So both the July payments and accounts for income tax and the March VAT has all been kicked back into next year, which is great news for short-term cash flows, but people do need to ensure that they are planning ahead and looking to make sure that they are going to have the cash available when the tax falls due. It's very easy to think, great, I don't have to pay that tax, but actually it's all going to come home to roost in early 2021, and for many businesses that could be quite a sort of painful period in terms of cash flows. So it's really, really important to get a good grip and a handle on what those look like at the moment.
Yes, I mean, Aidan, picking up on that point from Peter, there's obviously immediate actions that lenders are taking, and no doubt you'll be talking to people at the moment. But looking further ahead, when the taxman says he wants to be paid in January next year, that's going to be quite an important time for people to have prepared and to have spoken to their lenders. And similarly, lenders will also be saying, well, it's all, when you get an interest payment holiday, you're effectively rolling it up, aren't you, into your loan? So it's not a holiday, not a free holiday.
Yeah, that's right. I mean, it almost needs sort of a terminology change, really. It's not a free holiday at all. As you said, it's a period of interest roll up, and depending on the amount you're borrowing and over what term, it could prove to be really expensive. I mean, I think at the moment all lenders are being understanding, and I think they appreciate that this is a scenario that we never thought we would find ourselves in. And I suppose, as I said, being a banker, I suppose I would say this. I think lenders are being accommodating, and you've got various avenues open to you as a borrower, whether or not that's an element of restructuring or a further advance, or indeed payment holidays. I think what I would say is that from time to time we all have a tendency to struggle on, perhaps, and sometimes pretend that there isn't an issue. I would almost definitely, as Sophie said, to engage early, be upfront about the problem, work with your bank, and act before it's too late. Banks hate surprises, and the crime will almost certainly be in the cover up.
Right, and just thinking, sort of, many borrowers will have covenants with their banks, and some of those might be around rent roll or capital values. How are you looking at these rent payment holidays that have been discussed already this morning? Does that impact on those covenants immediately, or are you taking a view on those and waiting and seeing?
Well, again, I think you have to be sensible, and you know, as Sophie said, no one size fits all, and you have to look at these things in isolation. You know, a lot of the conversations I've had very early on after the Prime Minister's announcement around payment holidays was clients saying, I need 3 months, and you know, my immediate question back was, why 3? Why not 4 or 6 or 8? You know, let's look at your cash flow properly, really plan for this, and if you need longer, I'd much rather plan for that, and put something in place that's actually going to help you, rather than sort of just kick the problem down the road for 3 months.
Tom, valuing is presumably quite complex in the current market. No doubt the banks will want you to be valuing. How do you go about it?
Extremely difficult. I mean, I think every firm of valuers is busy rewriting, and the RICS as well, putting in lots of caveats. We don't know what's going on, and I think anybody that claims they do is probably stretching it a bit. So, you know, there's a base of what things were selling for before. I think there's certainly still been transactions continuing. People haven't dropped them. But it remains to be seen sort of where the market goes in all sorts of sectors. But I suspect the banks will probably want pretty precautionary valuations. So you've got this issue at the moment where there may be 3/4 deals done based on values from 3-4 months ago. You know, will the banks? I think there was talk in the press yesterday about some poor people being caught with mortgages having exchanged contracts, and they might have them pulled, which would be a pretty invidious situation, but from a financial point of view, logical. But I don't think there's any wholesale collapse in any asset values yet. Too early to call that one. And some assets will increase in value. So very, very fluid. And I think what this whole COVID thing doing is it's identifying sort of fractures in all sorts of well-established systems, and it's just incredibly difficult to call which way things are going to break. So difficult, yeah, challenging, but not impossible.
And Peter, if you were looking at a business and having to audit it and consider whether it was a going concern, how far ahead do you have to look to determine whether it is a going concern?
Well, from a pure accounting point of view, the definition of going concern is quite sort of tightly drawn. It's essentially, can the business exist in 12 months from the date of approval of that set of accounts? Clearly, that's very sort of technical approach, and for most businesses, it's much more important to look much beyond the immediate 12 months. Where we are carrying out audits, we've got there's a very high bar and a sort of great deal of professional duty to do quite a lot of work there, and there's a lot more work that needs to be done at the moment with the current situation to ensure that the forecasts and assumptions that clients are producing are sort of appropriately stress tested. We'll very much look at various sensitivity analysis on those assumptions, and run various sort of models to try and identify where the sort of risks in those forecasts are, to see if they are a going concern, both from a accounting point of view and in a sort of more long-term point of view. Banks will look to audit reports for reassurance that business is going concern, but I'm sure they'll also sort of do their own due diligence to look at the longer term, and that's actually what's key to clients, really.
Yeah, and will you be looking more carefully at directors' valuations of property assets?
I mean, again, the accounting rules are what they are, and in certain circumstances, directors are allowed to provide valuations for businesses, and the onus of what we have to do does depend on whether it's an audit or not. If it's just a pure sort of review of the accounts, then we don't have to challenge the assumptions quite so much. But clearly, there's going to be some quite searching conversations with clients to make sure that the correct approach has been taken and appropriate valuations are being included. I've got one large property client which is December year end, which we're busy doing the accounts for at the moment, and of course the value of a lot of those properties, as Tom said, may be materially lower now than it is the number that's going to be going in the accounts. It's very, very unusual to have had such a dynamic picture.
Sophie, sort of moving on to replacing lost sources of income. What are the areas that you think might be best to follow?
I think estates, having very much dealt with the sort of the immediate impact of the crisis, and now sort of at the sort of strategic planning phase of looking ahead of where can they sort of ride the wave where things are going well, where do they need to invest, and also, frankly, the areas that need mothballing or abandoning. And they're really trying to identify those sort of areas under different COVID restrictions, but also different sort of economic circumstances. So, for example, if you took something like holiday lets, in a sort of quick recovery scenario, and where the government restrictions lift quite quickly and with the right controls in place, we think this could become quite a good growth area, because there's pent-up demand for people to not be at home, and clearly the quarantining restrictions are going to make foreign travel very tricky. I think perhaps one of the biggest barriers to that is actual sort of local sentiment. We've already seen it in some areas where, quite frankly, they don't really want visitors in their local communities, but maybe that will begin to ease as people are getting out and about a bit more, and that's certainly the government message. However, if we don't see the government restrictions lifting sufficiently to enable that sort of holiday let business to bounce back, some estates might be thinking, right, well, what do we do with these properties? And it might be a case of them, perhaps in the short to medium term, going back into, say, the let residential sector. That's not a decision to make lightly, because it could have impacts on overall profitability. It might result in staff redundancies. And as I know Peter will be thinking, this could have some very serious tax implications as well, depending on the planning that's been done. I think it is interesting, though, that there has actually been a real sort of rural renaissance recently, with people wanting to get out of cities and perhaps realising that they can work more effectively from home than they thought they could before all of this. And this is actually an opportunity for estates to sort of capture this momentum and perhaps start promoting sort of live work accommodation and presenting houses and offices well, so that they're attractive to people coming out of cities. Clearly, and we spoke about it right at the start of the webinar, one of the key factors behind this is the degree of connectivity, and do you have super fast broadband, and does that support this change? I think it is also worth noting that COVID is only one thing that is affecting estate income. Tom was talking about it earlier. We were already talking about the phasing out of basic payments, and we were concerned about the sort of post-Brexit trade deals. This hasn't gone away. These are things that we were planning for already. And we're already monitoring opportunities to perhaps take advantage of the climate change agenda, with net environmental gain, carbon offsetting, renewable energy development. So there's plenty of areas, but it will again be on a sort of an estate basis as to which model suits which estate.
Yes. Well, you're mentioning connectivity, Tom. You live a few miles from me. You've had to go into your office today to do this call because your broadband is rubbish, whereas mine is really good.
Yeah, thanks.
Yeah. But aside from that, forestry is an area that's obviously been heavily in the news over the last few months, with the bidding war in the run up to the general election being at the height of it, I suppose. What do you see the future of forestry is now?
Well, forestry really has been the one sort of real boom sector in the rural economy, and there seems to be a bit of certainty going forward. Agriculture's got a cloud over it with BPS and so on. And so the existing forestry market, there's been an incredible increase in forestry values. There's a lot of money wanting to go into it. And the reasons for that, the tax treatment is very favourable. Timber markets are very positive. A lot of that's been underwritten by the demand for biomass in particular, which has been very welcome for a lot of estates over the past 4 or 5 years. But also we've now got the carbon attractions, and the forestry sector is the one area where we do have a tangible, as yet not easy to value product. There've been auctions for carbon credits and so on based on forestry. We don't quite know yet what everything's worth, but so there's a big government drive to plant, however many 30,000 hectares or whatever. But it's happening in Scotland because, I mean, for various reasons. But in England, it is demonstrably not happening. And so we've actually been looking into that and doing some subcontract work with the Forestry Commission about how to get it to work in England. But why is it not happening? Part of it must be to do with land values. And those land values are still underwritten by BPS. Part of it is to do with a lot of the land in the sort of Sandwich area. The very high uplands are all designated. You're never going to plant those. The lowlands are probably too productive. So there's a kind of, the middle of the Sandwich is in theory available. But there are also a lot of designations there. And there are a lot of landscape concerns. And England's landscapes are a lot smaller than Scotland's. But ultimately, there are memories of poor planting from the Schedule D tax-driven thing, which ended in the mid-80s. But ultimately, I think there's a lot of mindset with farmers who are locked into the idea that land is for food production. And what we need, I think, to get it going is a lot stronger push from central government to actually break through. There are chains in trying to get a scheme going. There are so many different reports you need, and it's never going to be perfect. But there needs to be a will to make it happen. But forestry, I think, if there's a big shake-up in the farming industry, forestry is a natural destination for a lot of people, and it seems to make sense economically.
Yeah. Ed, are you seeing your clients go into forestry? Is it somewhere the bank is looking to lend?
Yeah, absolutely, it is. We have a specific policy in place for lending to forestry. It's definitely something we see more of demand for in our Edinburgh office. But yeah, I mean, it's definitely an area that we're focused on. We like it as a class of asset being charged to the bank. It diversifies our security book, so we're very keen to assist where we can. The downside to charging an asset like a forest or looking at these sorts of loans is it's very capital intensive for banks. And over the last 10 years or so, the UK regulator has become very strict and put lots of rules in place for banks around their capital requirements. If you think of capital as the bank's raw material from which it makes profits, it's only reasonable that we try and use it as little as possible whenever we're lending money. So it can be very expensive depending on scenarios, but absolutely it's definitely something that we look to assist with.
And Aidan, just sort of looking ahead, clearly businesses that perhaps are not already in the hospitality area may see opportunities for themselves to develop hospitality businesses which are consistent with the requirements of post-COVID health and safety regulations, social distancing, whatever it may be. Would you see those as interesting prospects to look at?
Yeah, I mean, I'm not sure if it's surprising or not really, but since we've gone into lockdown, we've been incredibly busy. Now, some of that has been assisting existing clients, but the vast majority of it has been new clients with new borrowing requests, really trying to take advantage of the low interest rate environment or the market conditions. I think what I would say is that lending can be a very effective tool in building wealth or building income streams or even tax planning, but it's really important that we don't commit to any obligations that we can't comfortably meet. The other area of advice that I would always ask people to consider is around the ancillary risks, or the risks that we can't control. A really good example of this is around rising interest rates. So, you know, perhaps looking at that slightly more expensive fixed term rate, locking your cost of interest away for 5 or 10 years at a level that, you know, you can afford. Something I always insist on as well, and I would urge everyone to do this, is to have a plan B or a plan C for repayment, just in case things don't go the way that you expect. You know, you wouldn't really want to be on the end of what can be some very pointed advice from your bank to start selling assets when the market's not in your favour.
And you mentioned that you've been very busy since lockdown. Are you seeing incidents of some people coming to you, or are you hearing stories of people coming to a second bank because their principal bank has rejected them for a business interruption loan? Particularly, perhaps if it's a business that's suffered losses in recent years, that might be one that banks are not so keen to provide business interruption loans for. Have you seen anything like that? And indeed, I'll ask that question of the other panelists in a moment.
Yeah, I mean, it's a good question. I think probably a mixture of both. We're very lucky at Weatherby's. You know, for an old bank, we embrace technology, and really for us, it's been business as usual throughout all of this. You know, our phone lines run to our laptops, and I sort of took my laptop home, and the bank's up and running. So, you know, a lot of this has been through other lenders pulling out of the market, albeit on a temporary basis, or agreeing to a loan, but then having trouble perhaps sending a valuer out. So, you know, we've managed to find ways around this and sort of take a view where needed. And as I said, we've been really very busy over the last 8 weeks, and I think that's really just because we've sort of treated it as business as normal.
Peter, what have you seen in your practice on the business interruption loan area and difficulties people might be having?
Sure. It's been a range of experiences, I think, across the client base. Some have applied for the loan scheme and got them fairly easily, although there has been fairly significant delays in actually the one thing that the loan being approved, and another thing the cash arriving in the bank account. I think the banks are understandably swamped at the moment, trying to process all these loan applications. So getting the cash into the bank of various clients, there have been a few problems and delays there. Something which I saw quite a lot in the first couple of weeks when the business loan interruption scheme was first announced were people thinking that this was going to be a sort of easy source to access cheap finance, essentially, and then getting pushed back by the banks with the message that the loan scheme really is there to support entities which wouldn't otherwise have sufficient security. And of course, a lot of landed estates and farms, etc., do have a bit of extra security they could give. And I know the rules have since been slightly relaxed there, but sort of the underlying rationale for the loans, I think it took a while for people to get their heads around, and a lot of clients have been gently pushed back by the banks on, we can't apply for these loan schemes, but let's look at your general borrowing position and see what else we can do, but it might not be under that particular loan scheme. I'm not sure if that sort of rings sort of true with your experience, Aidan, or not. Or
yeah, absolutely. So that's almost definitely the angle that we're taking with our clients, is we don't actually look at CBILS, but you know, let's look at the overall scenario here, and you know, as I said at the start, there's often 2 or 3 different ways that we can work with people to get them through.
Yeah. Sophie, Tom, we've had a question regarding residential tenants on ASTs. As we know, there was effectively a lockdown on evicting people, although it wasn't quite as simple as that statement. Now that the market has reopened, do you envisage it being possible to move tenants on, and you know, particularly where there was an envisaged departure before the lockdown?
You want to go first, Sophie? Or?
I'll give my view from the south. Yeah, I think if we're talking about a situation where people were planning to move anyway, it was just in the normal course of their sort of life circumstances, then yes, I think we are beginning see that happening, and we've certainly actually seen some people on estates in the last week begin to move in, which is great, and is a first sense of things getting back to normal. The sort of second part of your question is perhaps where we haven't been able to evict people because of lack of rent payments and things, and whether that's going to change. What I would say, and this might be a South-specific situation, is that actually we've been quite surprised in a good way of the lack of debtor burden, I think, that has to date been induced by this situation. And it perhaps is a reflection of all the loan schemes and the furloughing and the other support that's been available. So I certainly don't have a situation where over the last few weeks I've been thinking in normal circumstances we would be serving notice on this tenant, but we haven't been able to because of this government situation. That may change as we see the furloughing support and other things changing. But to date, I haven't had my hands tied by government restrictions.
Yeah, just I mean, I would agree, Sophie, that there's no particular debt problem with residential tenants yet, but it probably could develop. I think working for Galbraith, I have an interesting perspective, and I can see across the border as to what their residential sort of security of tenure regime is, which is one step ahead of what we're about to get, where they're going to remove Section 20s and you won't be able to get possession. But actually, my experience over the past couple of years pre-COVID is that it is incredibly difficult, very difficult to move tenants on. And there are so many minor regulations with deposit schemes and gas certificates, and go on a website and put avoiding eviction, and there's all sorts of stalling tactics. So it's not, there is at the moment we have the mechanism to move people on, but we're not allowed to use it during COVID. But actually, it's not a great tool, and far better to do things by negotiation and agreement.
Yeah, I think I'd agree with that. I mean, I can recall last year a tenancy where it took over a year to get the tenant out, and even at the last minute when the bailiffs turned up, it was postponed by another 3 months.
And have you? I've just come off as a guarantor on as a rented property in Edinburgh. And when I actually read through the tenancy agreement, I was very glad I was in the tenanted sector.
Yeah, exactly. So moving on perhaps to the third theme, which is the new fiscal normal. And Peter, I know one of your partners produced a paper yesterday on this subject. What do you think is going to happen when we start to get some visibility on what's likely to happen next in terms of the economy?
I mean, it's clearly looking ahead at sort of future fiscal policies, very, very difficult. And as I said, I've got my crystal ball here, Alexander, which I've invested in these days. I think it's going to be very, very useful. Stating the obvious, first of all, clearly we're running up as a country historic levels of debt. There was calls I saw in the press yesterday for it to be sort of treated as a war debt and to be paid off over many decades, and not try and sort of recoup it in the short term. But the inevitable maths of it essentially are taxes will have to go up to pay for it. The million-dollar question, of course, is which taxes and how. I think that my colleague who you refer to put something out yesterday made a very interesting point that sort of contrary to the global financial crisis, where the easy scapegoat to beat was the bankers and the sort of bankers' taxes, etc. Then there isn't really an obvious scapegoat to sort of publicly punish in terms of policy, and equally there'll be lots of pressure not to put tax burdens on lower paid workers who've been at the front line of this whole thing and have been key to getting us through it. So it's sort of politically, it's going to be quite difficult to find the sweet spot to attack, if that's the right word, to raise those finances. I personally think it's going to be a multitude of approaches. I wouldn't be at all surprised if we saw an increase in direct taxes like income tax and corporation tax and VAT. Clearly, there's a multitude of ways that the various bands can be played around with to try and sort of pick off the income at various sectors of society, if you like. So one of the large sort of other potential targets is multinationals. There's been lots in the press over the last couple of years about sort of Google tax, etc., and sort of these cross-jurisdictional taxes, and how we can maybe try and capture a bit more of the profits which are arising from the likes of Amazon in this country. So that may well be something they go after. And then it does bring round the sort of potential spectre of a wealth tax, something which we wouldn't think Conservative government would look seriously at, but in a sense they've now got government's got carte blanche to slightly tear up a lot of previous policy, because it is exceptional circumstances, and I think exceptional measures will need to be looked at. So all is to play for. And then I've just really spoken about tax rises to date. Of course, there are all of the various tax reliefs that are in place. There's been, even before this, there's been lots of talk over the last year or so about reviewing IHT reliefs, BPR and APR, and there's been a number of various studies and sort of calls for evidence, and also tax simplification have spent quite a lot of time looking at how those regimes could be reformed. I wouldn't be at all surprised if some of those things accelerate through now, because they are, again, it's all easy ways to raise revenue for the Treasury. In terms of what can be done, though, there are we are at historically low rates of CGT, 20% on most assets other than residential property, and then of course asset values have dropped away. Those with portfolios of stocks and shares have seen a large percentage shaved off over the last few months. So we're spending quite a lot of time talking to clients at the moment about, actually, is it a good time to liquidate portfolios, wind up trusts, etc., whilst the tax and transaction costs of doing so are perhaps at a historic low. So there are things that can be done now, perhaps before those rates of tax go up. So there are opportunities to be considered at the moment.
Yes, I mean, I think it was Churchill who said, "Never waste a good crisis." Do you foresee policymakers looking at this as an opportunity to do things that were not palatable previously? For instance, bringing a wealth tax or a mansion tax, as it was called back in 2015, or something more radical than that even. What do you think on that one, Peter?
Absolutely. I mean, who knows? To say, it does give the government sort of carte blanche, as I said, they're going to have to be quite inventive to think of the different ways to raise the revenue, and it's going to be a balancing act between getting the economy back up and running and not taxing people too heavily in that regard, versus actually clawing back the financial position that the country is in. As I said at the start, the longer term position, I think, I very much hope the government will take that view. It's a war debt and has to be paid off for a long time. But I think it's going to be painful for many people in terms of helping the government pay for that by the increased taxes. But where they're going to come from, just who knows.
Aidan, when looking at people's projections when they come to see you, are you factoring in increased tax demands?
Not at the moment. I think it's all so far up in the air that it would be almost impossible to sort of paint an accurate picture. I mean, as I said, one thing we do is stress various elements of people's assets and income. And one thing we also do is assume a rise in interest rates and costs. So I think, for me, we're going to be plugging the gap through taxation. I think to make any sort of real difference, that will almost certainly be income tax and VAT increases, which will mean people's net income will almost certainly fall. But on the other side of that is, interest rates are probably almost certainly definitely going to stay low for the foreseeable future, and so people's costs of borrowing will remain low. So in a way, we've already built in a contingency, and we've got a good buffer there for any changes in income streams.
Sophie, APR is obviously something that's very important to many estates and has been very important in the past. Do your colleagues have any views on APR?
I'm sure they do, and I certainly do. I mean, before all of this took place, we were certainly concerned about the possible removal of APR, and that's why a lot of estates have been looking at developing their trading businesses, their trading enterprises, and trying to utilise these to balance out the sort of non-trading asset part of the portfolio. And I think that's particularly why we need to be really careful in not making short-term decisions in replacing lost income in the current situation. I mentioned about potentially moving holiday lets into the residential sector. That could be a decision that really did undermine a lot of tax planning. So where you're trying to rely on BPR. So yes, we were concerned about it. We're still concerned about it, and current decisions need to be made in the context of the structures in place.
Tom, what are your thoughts?
It's interesting to look at some of those very expensive Balfour schemes that were set up a few years ago, when they were maxed out to 49% on the entire matrix. But actually, if you reflect when that was going on, looking back at what had happened, if you look at the corresponding graphs of agricultural and residential property, when we first started doing them, residential was going vertically and agricultural was stationary, and the roles reversed. So the dynamics of the whole thing are complicated, and it's, as Sophie says, if you start, it actually hampers manoeuvre in terms of changing use. But again, you know, they might switch the 50-50 to 80-20. That actually scotches quite a lot. And then there's talk about a flat rate and no APR or BPR at all, which is, if you're a mixed estate, you win on the residential, but you lose big time on the agricultural. So we're looking at shifting stuff across generations at the moment, where there's limited APR, but there are all sorts of pitfalls to it. And I think the message is, you know, if you've got a clear plan, it's probably worth accelerating it and getting on with it. But it's very, very difficult to second guess. But the danger is that for my entire career, and forgive me, Peter, but the accountants and solicitors, both of you, before every budget, they cry wolf on APR, and we all do things, and it hasn't happened. Although, again, within my career, agricultural property relief was 30% and 50%. You know, so things do change, and we get locked into the norm. The norm ain't there anymore. So interesting to see what happens.
So to wind things up, I thought I'd ask a couple of predictions for what you think might happen in the next 12 months, or something you've been doing differently as a result. We've obviously all been doing something differently because we're sitting in well, 4 of us are sitting in our homes, but we talked about this the other day. Peter, you had an idea about a new tax, perhaps on unspent income. What did you mean by that?
Yeah, so this was entirely blue sky thinking, and I should stress I'm not an economist, but it's a conversation with somebody talking about actually how to restart the economy, and the fact that we are all, I think, going to be a lot more, or already are being a lot more cautious with our discretionary spends at the moment. Sort of across the board, there's a fear of either people's income has already dropped away, or sort of businesses struggling in the future. So as a nation, we are going to be, our purse strings are becoming a lot tighter, I'd have thought. So as a way of sort of stimulating that, somebody was hypothesizing, almost have a tax on unspent income to encourage everybody to basically spend what they're earning and keep the wheels turning, if you see what I mean, keep the capital flowing, which I thought was conceptually quite interesting. Although, as with all these things, when you look at it in detail, there are lots of holes and pitfalls and problems with it. But conceptually, I thought it was quite a sort of good thought exercise. Anyway.
Yeah. Aidan, what are Weatherby's thinking about?
I think we're thinking that it's almost certainly going to lead to higher taxation, and as I said, for me, that's going to be on an income tax and VAT. For us as a bank, agile working is almost certainly here to stay for the foreseeable future. It's working for us incredibly well, and there's no real reason to put me on a train back into London. And I was actually speaking to a client yesterday, and we were talking about stamp duty, and perhaps whether they might revisit that and actually reduce the rates of stamp that we're paying. There's an argument there to say that this would encourage activity, foreign investment, and probably increase the Treasury's take. So I think there's all sorts of things they could look at, and not all of them lead to higher taxations in every area.
Sophie, drive-in cinemas, you mentioned a little bit earlier. Any other ideas out there?
It's difficult. We want to focus. I'm an optimist. I want to focus on the sort of the radical innovations and the positive opportunities. I think the reality is that at the moment, a lot of clients are making the difficult decisions. They're very much focused on, let's just do the essential work on properties whilst cash flow is uncertain. But then there are also the more positive things. How do we deal with social distancing? How do we promote the safety measures in place? How do we adapt what we've already got? So that all sits alongside the hopeful drive-in cinemas, etc.
Tom, what are you?
Well, I think the message is probably don't panic. And really the watchword that I get is be nimble. Get yourself prepared. Don't jump into anything headlong, but have your facts and figures organised. If you're in a difficult position, try and think through how you're going to get out of it. If you're in a strong position, think of the opportunities you can take. I think echoing something that Aidan said earlier on, the watchword is you've got revenue will dry up, will shrink in the short term, but the asset base will not disappear. And the danger is asset base shrinks, but then you're selling into a dead market, and you may be selling assets that you thought were devaluing, but have got all sorts of latent things in there. And I'm thinking particularly of carbon, and then also, as Sophie's referred to, the increased desire for people to live and work in the countryside, because it will appear to be a safer place. So yeah, it's going to be interesting times, and I'm not quite sure. Well, we just have to monitor it closely.
Yes, as I said earlier, Churchill said, "Never waste a good crisis." I was listening to a podcast, or not a podcast, webinar yesterday, being run by a university, and they had a speaker there called Thomas Piketty, quite well known for his views against capitalism. And they ran a series of questions during the seminar, and the people listening to it, there were apparently 500 people listening to it, I think 70% of them thought that a successful economy and high taxation were perfect bedfellows. I think more than 70% thought that billionaires should be taxed out of existence. But happily, also more than 70% thought that people should be allowed to leave their wealth to their children. And that perhaps tells you a little bit more about the people who are listening to the seminar rather than anything else. But thank you everybody for your time this morning. We're finishing a few minutes earlier than advertised, but that hopefully will give everybody a chance to get a cup of coffee before the next meeting's at 11 o'clock, no doubt. And with that, thank you, Tom, thank you, Sophie, thank you, Peter, thank you, Aidan, and thank you everybody who has dialed in to listen to the talk today.